For decades, the global economy ran on a simple assumption that the world would keep becoming more connected, goods would move freely, capital would flow efficiently, supply chains would stretch across continents because it was cheaper, faster, and more profitable. That assumption no longer holds, and once you see it, you can't unsee it. The most important change happening right now is not interest rates. It's not inflation headlines. It's not even market volatility. It's the quiet reversal of globalization. All at once. Not loudly, but structurally. Supply chains are no longer optimized for efficiency alone. They are being redesigned for resilience, security, and control. That single shift changes everything. For years, companies asked one question: how do we make this cheaper? Now they ask a different one: how do we make this safer? Safety from trade wars, safety from sanctions, safety from political leverage, safety from sudden disruptions that can shut down production overnight. This change didn't start with one event. It built slowly. Pandemic shutdowns exposed how fragile just-in-time systems really were. Trade conflicts revealed how dependent countries were on rivals. Wars reminded governments that supply chains are not neutral. They are strategic weapons. N1C geopolitics enter supply chains. Efficiency stops being the priority. Reliability becomes king. This is why companies are reshoring and friendshoring, not because it's cheaper, it usually isn't, but because it reduces political risk. Factories are moving closer to home. Critical components are sourced from allies instead of adversaries. Redundancy is being built where optimization once ruled. That sounds like a corporate logistics issue. It isn't. It's an inflation issue, a margin issue, a growth issue, and, most importantly, an investment issue. Because when supply chains fragment, cost structures change. Production becomes more expensive. Inventory buffers grow. Transportation routes multiply. Those costs don't disappear. They get passed on. This is one reason inflation has become more persistent than many expected. Not because demand exploded, but because supply has become constrained and politicized. And this is where most investors get caught. Flat-footed. They analyze companies using old assumptions: global sourcing, stable trade routes, predictable cost curves. But those assumptions no longer apply. A company that looks cheap on paper may actually be vulnerable to geopolitical friction. Another that looks expensive may be buying resilience. That protects future cash flows. Markets haven't fully priced this in yet. That's the NICHO, opportunity, and the risk. Because geopolitics doesn't move in quarterly earnings cycles. It moves in decades. When nations decide certain industries are strategic, they stop playing by free market rules. Semiconductors, energy, food, critical minerals, technology infrastructure. These sectors are no longer just economic. They're political. And politics rewrites incentives. Subsidies appear. Export controls tighten. Tariffs reemerge. Capital flows get redirected. If you're investing without factoring this in, you're driving using yesterday's map. The world isn't becoming smaller anymore. It's becoming more segmented, and segmented systems behave differently. They are less efficient, more redundant, more expensive, but also more durable for those positioned correctly. This is why 2026 matters. Not as a prediction year, but as a transition window. The investments that benefit from the old world are peaking. That the investments aligned with the new world are still being built. If you want to understand where long-term capital is flowing next, you have to understand this shift. Because geopolitics is no longer background noise. It is the operating system, and if you treat it like a headline instead of a framework, your portfolio will feel the mismatch before you understand why. Here's the uncomfortable reality most investors avoid. Supply chains are no longer just about moving goods. They are about power. Who controls production? Who controls transport? Who controls choke points? And who can deny access when it matters? Most. In the old world, disruption was accidental. A strike, a storm, a logistics error. In the new world, disruption can be intentional. That changes how risk works. When governments realize that cutting off access to key materials can weaken rivals, supply chains stop being neutral. They become leverage. This is why we're seeing export restrictions on technology. Why rare earths and critical minerals are being nationalized. Why energy infrastructure is being politicized. It's not ideology, it's strategy. And strategy doesn't care about market efficiency. It cares about advantage. For investors, this introduces a new layer of analysis. You're no longer just asking, is this company profitable? You're asking, is this company exposed? Exposed to sanctions. Exposed to taxes. Exposed to regulatory retaliation. Exposed to dependency on a single geography. The most dangerous exposure is invisible exposure. A company can look diversified on the surface and still rely on one country for one irreplaceable component. That's fragility. And fragility gets punished during geopolitical stress. This is why certain sectors experience sudden repricing events that feel irrational. They aren't irrational. They're geopolitical risk being priced in all at once. Another major change is the rise of government involvement in capital allocation. In the past, markets decided winners and losers. Now governments are deciding through subsidies, through industrial policy, through national security mandates. This creates distortions. Some companies receive massive support, others are quietly sidelined. If you ignore this, you may be investing against policy instead of alongside it. That rarely ends well. This doesn't mean markets are rigged. It means the rules are changing, and rule changes always create mispricing. Example, companies that enable domestic production, logistics, automation, industrial software, infrastructure suddenly become more valuable, not because demand exploded overnight, but because governments are guaranteeing future demand. Meanwhile, companies reliant on cross-border arbitrage face margin pressure, their cost advantage erodes, their pricing power weakens. This is why geopolitics often shows up in earnings. After it shows up in policy, investors who wait for the earnings impact are already late. Smart capital follows. Incentives early. Now here's the key. Mental shift. You don't need to predict wars or treaties. You need to identify directional alignment. Which countries are securing supply chains? Which industries are being protected? Which materials are being classified as strategic? Those answers tell you where capital is being guided. This is also why volatility has increased. When policy drives markets, pricing becomes discontinuous. Announcements matter more than forecasts. Rules matter more than guidance. And markets hate uncertainty, but investors who understand the structure can navigate it. Because uncertainty creates dispersion. Dispersion creates opportunity. Not everything goes up or down together anymore. Some assets benefit, some suffer. Your job is not to panic. It's to reposition. Geopolitics is not a temporary disruption to supply chains. It's a permanent feature of the new system. And permanent features require permanent strategy adjustments. So let's bring this home. Because macro insight without action is just intellectual. Entertainment. The biggest mistake investors make in periods like this is staying mentally anchored to the old regime. They keep optimizing for efficiency. They keep assuming normalization. They keep waiting for globalization to come back. It won't. The new regime rewards different traits: resilience over efficiency, control over scale, redundancy over optimization. That applies to companies and portfolios. The first implication is inflation. Realism. Geopolitically fragmented supply chains are structurally inflationary. Not hyperinflationary, but sticky. That means assets that rely on low input costs and global arbitrage struggle. Assets with pricing power and domestic control do better. The second implication is sector selection. Industries tied to infrastructure, energy, defense, logistics, automation, and materials gain strategic importance, not because they're trendy, but because they are necessary. Necessity creates durability. The third implication is geographic exposure. Global diversification still matters, but blind diversification. Owning everything everywhere is not the same as owning aligned regions. You want exposure to countries building capacity, not just consuming it. The fourth implication is patience. Geopolitical transitions don't play out in months. They unfold over years. This rewards investors who think in cycles, not quarters. Short-term noise will be violent. Long-term direction will be clearer. The fifth implication is humility. No one sees every move coming, but you can position for themes instead of events. The theme is clear. Supply chains are being re-engineered, costs are rising. Politics is embedded in economics, and capital is following protection, not efficiency. This doesn't mean everything is bearish. It means different things win. If your portfolio is built for the old world, it will feel unstable. If it's built for the new one, volatility becomes opportunity instead of threat. This is why understanding geopolitics is no longer optional for investors. It's not about predicting headlines, it's about understanding incentives, and incentives are being rewritten right now. The question is not whether geopolitics will affect your investments, it already has. The real question is whether you're positioned for the direction of change, or stuck defending assumptions that no longer apply. Because supply chains aren't just moving goods anymore, they're moving capital, and capital always moves first.